Well, inflation showing little sign of slowing in March, the PCE price index rising to 2.8% compared to last year, coming in slightly hotter than anticipated. The data solidifying traders' expectations for September cuts. To break this all down, we have Brian Rose, UBS Global Wealth Management's U.S. senior economist here. It's great to talk to you. So talk to us just about how you're looking at this print and what this overall means for the Fed here, do you think, in the coming months?
Sure. So the recent inflation data has been too high for the Fed to think about cutting rates, but it's not that far out of what the Fed was expecting. So if you go back to the March FOMC and the dot plot, the Fed was saying we're going to cut rates 3 times by the end of the year, and we're looking for the core PCE inflation to be at 2.6 at the end of the year. And in March, we were at 2.8. So it's not a huge difference. We just need inflation to come down a little bit, and then the Fed can think about cutting rates.
Certainly. And as you look across some of the indexes here within this broader report here, is there anywhere that you think the Fed does not have a lever that it can pull in order to bring down inflation in some of the stickier areas? Namely, it's been, especially as we think back to what the CPI and that hotter than expected read was, it's been shelter, it's been energy costs. And so how does that pair with this PCE report for you?
Yeah, I'd say the big problem for the Fed isn't those things. They're very confident that shelter inflation will slow because we have more timely data on rents, which is clearly showing that shelter inflation will head down. The big problem for the Fed has been core services excluding shelter. These are the things that are most closely linked to the strength of demand and also to wage growth. And this is where, the Fed's been talking about this for 2 years. This is where they want to see disinflation, and the readings are just too hot. So the good news for the Fed, though, is that wage growth is slowing. So that does imply that this category of inflation should slow over the medium term. And again, in our view, we're not that far away from circumstances that would let the Fed start cutting rates.
So, Brian, what does that timing then look like, do you think?
So our base case is September. Of course, earlier we were talking about June, but because of the higher inflation prints we've had so far this year, we've pushed that back to September. There are risks that if we continue to get the sort of inflation prints we've had recently, it could get pushed back even further. But again, you look at things like the wage growth, which is clearly trending lower, and also we had the GDP coming in below trend in the first quarter. Slower economic growth would also help to get inflation down. So, we're optimistic that we will get inflation prints similar to what we got in the second half of last year. And, that's good enough for the Fed to start cutting by September.
Yeah, you mentioned wages. We're going to get a trove of economic data on the employment front next week as well. What are you anticipating, especially as we're looking to see which industries are adding the most jobs, but at the same time, the pay that comes along with those jobs that are being added in industries that are still trying to rebound?
All right. So from the Fed's perspective, they don't have a mandate on growth or payroll growth. What they really are interested in is the balance between supply and demand in the labor market. And the ultimate measure of that for the Fed is wage growth. So because of the situation where we have lots of immigrant labor coming in, it's a bit hard to gauge what is a sustainable pace of payroll growth right at the moment. So the Fed's really focused on wages. And again, you clearly see in all of the wage measures that things are slowing. Also, when the Fed contacts its businesses across the country, they put that information in the Beige Book, also clearly showing less pressure on wages. So, the Fed is mostly concerned about the medium-term outlook for inflation. Where's inflation going to be 2025, 2026? They're not that, worried about, the monthly prints. As long as the outlook is for inflation to slow towards the target, again, say by the end of 2026, that's what they want to see before they start cutting rates. And wages, I would say, are very, very important component of that.